I recently read an article in Money Sense magazine, which is about a corporate business owner, and the question was, should they draw on RSPs earlier or later? So I thought I'd share an example of some work I have done for a client. And he sold the majority of his business at age 65, wanting to keep a small portion to age 75. And the question we asked was, should he take his salary from the business now and delay his RSP withdrawals? Or should he just keep all of his earnings inside the corporations to grow and draw on his RRIF or RRSP now? And this is what we found. When we look here at the net worth, we can see net worth is about $1.2 million. And over here, $1.3 million. If we look at the final estate after taxes, again, we're about 1.1 and 1.2. So there is an advantage to drawing the RSP early, but there's also added flexibility. And let's take a look at that. We're going to look at the client's income assets. And what we can see here, this is just, he's got a condo, he's going to convert that to a principal residence. We have non-registered investments here, depleting those over time. This is the RRSP account. When we look at that, we can see there's still a healthy account size, even at age 82, 81. And often when we're doing planning work, it's nice to draw down on that early, just in case the spouse should pass early. It gives us more flexibility in terms of tax planning. And then he's contributing to the tax-free savings account. When we look over here on this side, same thing with the condo converted to a principal residence. We always maintain a little bit of non-registered investments. The RSPs gradually coming down, which is nice. So really by about age 78, 77, we've depleted most of the RSP. So that's good. Corporate investments, they're growing over time. We're starting to take dividends from the corporation. We've set up the shares in different class of shares so we can pay a different amount of dividends. They've come out, and we've got extra flexibility keeping money in a corporation. It doesn't have to be paid out like the RSP. And then, of course, we've got the tax-free savings account here growing over time. So when we look at the final estate, most of the money is in tax-free savings account, which is great. This little spike here at the end, this is the sale of the principal residence, and there's cash going into the estate. So just to conclude, yeah, we do see that there is, in this case, a bit of an advantage to take RRSP RRIFs early, and there's added flexibility.